1,082%. Let that sit for a second. Not a stock, not a single lucky drill hole, not a one-time trade where I mortgaged my future on a rumor and happened to be right. I'm talking about a portfolio extended internal rate of return across 338 investments, 157 active tickers, and years of buying into the dirtiest, most overlooked, most misunderstood corner of the public markets. 1,000%. I'm not telling you that to brag. I'm telling you that because I want you to ask the question that number demands. What kind of asset class makes that possible? And then I want you to sit with the follow-up. Why has nobody told you about it? Because while the financial media has spent the last decade building a cathedral around venture capital, Sandhill Road, Series A rounds, unicorns, billion-dollar valuations, Sequoia, Andreessen Horowitz, the whole mythology, there's been a parallel universe operating on public stock exchanges in Toronto, Vancouver, and New York, a universe where retail investors, not accredited elites, get to play the same high-stakes, power law game where the rocks don't care about your net worth, where a discovery is a discovery, and when you're right, you're really right. That universe is junior mining, and today I'm going to make the case, with math, with structure, with real names and real returns, that it is a better venture capital play than venture capital itself. This is episode 10. Welcome to Junior Mining Gold, the podcast where we dig deep into the raw, unfiltered world of building fortunes from the ground up. I'm your host, Dusty Nugget, the guy who's ridden more boom and bust cycles than a rodeo cowboy on a bull named Recession. If you're new here, we don't sugarcoat the grind. We expose the guts of business, from solo hustles to empire-building shares. Before we dig into the dirt, this episode is brought to you by JuniorMining.Gold. Are you tired of missing the boat on the next big discovery? JuniorMining.Gold is your ultimate radar for the high-stakes world of small-cap mining. We track the drills, the assays, and the movers so you don't have to. If you want an edge, head over to JuniorMining.Gold. Now, let's get to the gold. Let me start with a confession. I understand why people worship venture capital. It's a genuinely compelling story. A small group of elite investors operating with asymmetric information and deep networks write checks into the earliest stages of companies that go on to define entire industries. Google, Amazon, Facebook, Airbnb. The list of VC-backed companies that reshape the world is real, and the returns generated for early investors in those companies are real. We're talking multiples that make the stock market look like a savings account. The mythology is seductive. A 25-year-old with a laptop and a pitch deck walks into a conference room in Menlo Park and walks out with $10 million. 6 years later, they're a billionaire. The VC who wrote the check is a genius. The system works. Except here's what the mythology leaves out. For every Google, there are hundreds of companies that took the money, burned through it, and disappeared. The dirty secret of venture capital, the one that even sophisticated LPs sometimes struggle to internalize, is that the model is designed to fail most of the time. That's not a bug. It's the feature. Venture capital runs on what mathematicians call a power law. The distribution of returns is so skewed that a tiny percentage of investments, 5 to 10%, generate 90 to 100% of the total gains. The rest, zeros, or close to it. Top quartile VC funds have what's called a deal batting average of 30 to 40%, meaning less than half their bets return even the original capital. The strategy works not because VCs are consistently right. It works because when they're right, they're extraordinarily right. One fund returner, one company that goes from a $10 million check to a $10 billion outcome. That's the math. Now here's the part they don't put in the pitch deck. You can't play that game. Not directly. Not unless you have a few $1 million sitting around that qualify you as an accredited investor. And even then, unless you have the relationships to get into the top-tier funds, the ones that actually capture those returns, you're not getting the real product. You're getting the echo, the second-hand exposure, the fund of funds with 2 layers of fees that turn a 15% gross return into something your index fund could beat. The average retail investor is locked out of venture capital at exactly the moment it creates the most value. Early stage, before the IPO, before the headlines, before the stock is on every brokerage platform and already priced for perfection. So that's the church, beautiful on the outside, members only on the inside. Now let me show you the building right next door that nobody's talking about. Junior mining is structurally the same game as venture capital. I want to be precise about that because it's not a metaphor. It's a mathematical reality. Both industries operate under power law return distributions. Both have high failure rates by design. Both require diversification across many positions to capture rare, outsized wins. Both reward early entry and punish late money. And both are driven by a fundamental truth. Most of the time you're going to be wrong, but when you're right, you can be spectacularly, life-changingly right. The geology makes the power law inevitable. Here's a number that should reframe how you think about this sector. Roughly 1 in 1,000 geological anomalies becomes a prospect worth drilling. Of those prospects, roughly 1 in 1,000 becomes an economic mine. That's a 1,000,000 to 1 hit rate at the grassroots level. And yet the companies pursuing those targets are publicly traded, accessible to anyone with a brokerage account, and regularly produce returns of 100 to 500%, sometimes more, when they hit. That's not luck, that's power law math operating exactly as designed. The mining industry even has its own version of the startup life cycle. It's called the Lassonde curve, named after Pierre Lassonde, one of the co-founders of Franco-Nevada and one of the most successful royalty investors in mining history. The curve maps out how market value moves through the life of a mining company. In the early stages, concept, early drilling, first anomalies, there's excitement. Speculators pile in. The stock moves on hope and narrative. Then comes the discovery, a significant drill intercept. The stock spikes. This is your product market fit moment. This is when the headlines happen and the retail money chases price. But then something interesting happens. The discovery phase ends and the work begins. Feasibility studies, environmental permitting, engineering, community consultation. Years of grinding technical work that doesn't produce exciting press releases. The hot money exits, the stock drifts. Institutional interest is minimal because the story isn't clean yet. This is what's called the Orphan period, and it is without question the most misunderstood and most profitable window in the entire junior mining life cycle. I'll come back to that, but first, let me tell you why junior mining beats venture capital at its own game. Advantage 1. You can actually play. This is the most basic and most important point. Junior mining stocks trade on public exchanges. The TSX Venture in Toronto, the Toronto Stock Exchange, the OTC markets in New York. You don't need to be accredited. You don't need relationships. You don't need a $10 million minimum. You need a brokerage account and the willingness to do the work. Venture capital is gate-kept by design. The best funds don't need your capital. They turn away institutions. The access problem is structural and intentional. Junior mining doesn't care who you are. If you can identify a company with a great geological target, a disciplined management team, and a tight share structure before the market does, you get the same return as the most connected investor in the sector. The rocks don't discriminate. Advantage 2. Transparency that venture capital can never match. This is the one that surprises people when they first hear it, because junior mining has a reputation, somewhat earned, for opacity and promotion. But here's the regulatory reality. In Canada, which hosts the majority of the world's junior explorers, every technical disclosure is governed by National Instrument 43-101. This is not a suggestion. It is the law. Under NI 43-101, a company cannot cherry-pick its best drill results and bury the bad ones. It must report everything. Every assay, every intercept, including the ones that missed, and every scientific or technical statement must be certified by a qualified person, a licensed professional who is legally liable for the accuracy of what they sign. The word resource is not a marketing term in this world. It has a strict legal definition. Inferred, indicated, measured. Each category represents a specific level of geological confidence, each earned through documented work. Compare that to venture capital, where a startup's valuation is whatever the last funding round said it was, where 41% of unicorns, billion-dollar companies, notionally, hadn't raised capital since 2022 and are likely worth significantly less than their marked value. In late 2025, roughly 222 unicorns out of 857 had probably already slipped below $1 billion in real value, but they're still carried on fund books at inflated marks. That's not transparency. That's optimism, institutionalized as accounting. Junior mining is a glass box. Venture capital is a black box. For a sophisticated investor, that's not a minor detail. That's the difference between doing real due diligence and buying a story. Advantage 3. Liquidity on your terms. When you invest in a venture fund, you sign up for a journey. The typical fund life is 10 to 12 years. Capital calls come when the GP decides. Distributions come if and when exits happen on the GP's timeline, not yours. DPI, the actual cash return to investors, hit historic lows recently, around 6 to 10% of assets under management. LPs have committed trillions of dollars to private funds and are waiting, with decreasing patience, for actual money to come back. Junior mining stocks are public. If you need liquidity, you sell. It's not always easy. Many microcaps trade thinly, but the option exists. You're not locked up. You're not waiting for an IPO window that keeps not opening. You're not dependent on a GP's relationships with investment bankers. When a drill result lands, you can act. When the thesis breaks, you can exit. That optionality has real value, and it's completely absent from the traditional VC structure. Advantage 4, the entry point is now. Here is the macro argument that I think makes junior mining not just a structural equivalent to venture capital, but specifically a better bet in this moment in history. Venture capital has spent 20 years harvesting a very specific type of scarcity, information scarcity. Software companies built moats out of proprietary data, network effects, and the accumulated advantage of code that was hard to replicate. That model worked extraordinarily well when the cost of intelligence was high and the supply was limited. Generative AI just blew that up. When you can build a competitive software product in a fraction of the time it took 3 years ago, when foundation models are commoditizing code and automating workflows at every layer of the stack, the moats that VC was built on are eroding. The scarcity is shifting. It's moving from bits to atoms, from software to the physical infrastructure that runs it, from algorithms to the materials that make the hardware possible. Copper, lithium, cobalt, uranium, gold. These aren't just commodities. They are the physical substrate of the digital economy. You cannot build a data center without copper. You cannot run an electric vehicle without lithium and cobalt. You cannot maintain grid stability as you electrify everything without massive mineral inputs. And unlike software, a mineral deposit cannot be disrupted by a better algorithm. It cannot be forked. It cannot be open-sourced. It sits in the ground, and the geology either works or it doesn't. That is what I call the alpha of atoms. And in 2025 and 2026, as the AI build-out continues and the demand for physical infrastructure accelerates, the junior mining sector is sitting at the intersection of a structural supply deficit and a speculative capital rotation that hasn't fully arrived yet. This is early innings. Let me get specific, because frameworks without evidence are just philosophy. In 2022, Great Bear Resources was acquired by Kinross Gold for approximately $1.8 billion. The company had been trading for pennies a few years before discovery, drilling at the Dixie project in Ontario, started returning results. Early investors who bought before the discovery and held through the acquisition made returns that would make a Series A VC partner blush. Patriot Battery Metals, their Corvette lithium project in Quebec. In 2022 and 2023, as their drill program returned hole after hole of high-grade spodumene pegmatite, the stock ran from under $1 to over $15. That's a 1,500% return for investors who were positioned before the world figured out what was happening in the James Bay region. Filo Mining, copper and gold in Argentina. Early believers in the Filo del Sol project watched the stock move from the low single digits to over $30 before the company was taken out in a joint acquisition by BHP and London Mining. The deal valued Filo at roughly 4.1 billion Canadian dollars. These aren't anomalies. They are the power law working exactly as it should. In junior mining, the fund returner isn't a once-in-a-generation event. It's the expected outcome for a well-constructed, sufficiently diversified portfolio. The question isn't whether the big wins exist. They clearly do. The question is whether your portfolio is structured to capture them. My portfolio's extended internal rate of return of 1,082% across 338 investments and 157 active tickers isn't the result of picking one lottery ticket. It's the result of building positions across a broad base, doing genuine technical due diligence, and having the discipline to hold through the orphan periods and add when others are running away. That's the venture capital model, applied to geology and operating in public markets that anyone can access. I want to come back to something I mentioned earlier, because I think it's the single most actionable insight in this entire episode. The orphan period on the Lassonde curve is where fortunes are built, and almost nobody has the stomach to operate there. Here's the dynamic. A junior mining company makes a discovery. The stock rips. Excitement is everywhere. Then the company does exactly what it's supposed to do. It begins the long, tedious, expensive process of defining the resource, completing engineering studies, engaging with regulators, and preparing for a development decision. News flow slows down. The speculators who bought on momentum exit. Generalist investors who don't understand the sector move on to something with more obvious near-term catalysts. The stock drifts lower, sometimes dramatically lower, even as the underlying project is being systematically de-risked. The geological uncertainty that once made the stock speculative is being resolved in the company's favor, but the market isn't paying attention. This is where a venture capital framework becomes your most powerful tool. A sophisticated VC investor doesn't abandon a portfolio company because it's in the grind of building out its go-to-market. They maintain or increase conviction because the product has been proven and the company is doing the work. The interim pain is the price of admission for the development stage rebound. In junior mining, the equivalent is buying into a company that has already made a discovery, already has a resource estimate, and is currently being completely ignored by the market because it's in feasibility. You are buying a proven asset at a discount, often at 75 to 85% below what the underlying resource is actually worth in the ground. That's not speculation. That's value investing with a power law kicker. The late-stage VC equivalent, buying into a company after it has proven its product but before the institutional money has arrived, is one of the most consistently profitable strategies in private markets. In junior mining, you can execute that exact strategy in a public market, and you can get in at prices that the VC world would kill for. So how do you actually construct this? The answer is the same as in venture capital. Diversify broadly, stage your capital, and concentrate into your winners. The mining industry has its own version of the venture studio model. It's called the prospect generator. A prospect generator is a company that uses its geological expertise to identify and stake mineral targets, then brings in major mining companies or other juniors as partners to fund the expensive drilling. The prospect generator retains a royalty or a carried interest in each project. It runs lean, keeps dilution minimal, typically 5 to 10% per year versus 20 to 30% for traditional explorers, and maintains a broad portfolio of active targets. Think of a prospect generator the way you'd think of a seed stage incubator in venture. It's running a high volume of low-cost experiments across a diversified portfolio of geological ideas. Most will amount to nothing, but the hit rate doesn't need to be high when the structure ensures you're exposed to enough shots on goal. One discovery in a prospect generator's portfolio can return the entire value of the company many times over. Building a portfolio around 10 to 15 high-quality prospect generators gives you indirect exposure to hundreds of exploration targets. You're not betting on any single drill hole, you're betting on the system. Layer on top of that a set of discovery stage juniors, companies that have already made an initial find and are defining the scale of the resource. This is your Series A equivalent, higher conviction, larger position, but still early enough that the upside is significant. And then your late-stage positions, developers in the orphan period, companies with proven resources trading at deep discounts to net asset value, waiting for the market to re-engage when a construction decision or a financing event brings them back into focus. Capital discipline is everything in this framework. Demand that management teams keep general and administrative expenses under control, ideally less than 25% of total spending. Require an 18-month cash runway before you commit capital, because companies that run out of cash during bear markets dilute existing shareholders catastrophically. and focus on geological merit over promotion. The junior mining market is full of stories dressed up as companies. Your edge is the ability to tell the difference. I'm not going to sit here and tell you this is easy. If it were easy, everyone would be doing it and the returns would disappear. Junior mining has real risks that are structurally different from venture capital, and ignoring them is how you lose money. The dilution spiral is the most insidious. Because these companies have no revenue, they must continuously issue new shares to fund exploration. A company with 40 million shares outstanding today can have 500 million shares outstanding in a decade if it never makes a discovery. Every financing round chips away at your ownership. Every warrant issued creates an overhang on the stock price. The math only works if you're buying into companies that are making real progress and exiting the ones that aren't. Then there's commodity cycle correlation. Unlike a portfolio of software startups, where each company lives or dies on its own product merits, junior mining stocks all move together when commodity prices move. A copper bear market hits every copper explorer, regardless of geological quality. This is the key structural difference from venture capital. Your portfolio isn't fully independent. It's partially a leveraged bet on metal prices. That's powerful when metals are running. It's brutal when they're not. You need to understand where you are in the commodity cycle before you size aggressively. Liquidity in the microcap space is genuinely thin. One large seller can gut a stock price in an afternoon. You need to size positions with the understanding that your exit might take time, and that trying to exit quickly in a bad market can be costly. This is the flip side of the liquidity advantage I described earlier. Yes, you can sell, but the market's capacity to absorb your sell isn't always there. And finally, jurisdiction risk. The difference between a mine in Quebec and a mine in a politically unstable jurisdiction is not a small thing. Permitting timelines in the United States average 29 years, not a typo, due to multi-agency regulatory processes and litigation risk. Canada has its own complexities, particularly around Indigenous consultation. The best geology in the world is worth nothing if you can't build the mine. I want to be clear-eyed about all of this because the goal isn't to oversell you on a concept. The goal is to give you a framework that works, with all of its moving parts, including the ones that can go against you. The macro setup for junior mining has never been more compelling in my investing lifetime, and I want to explain why, because the timing of when you apply a framework matters as much as the framework itself. The global electrification build-out is creating a structural demand for copper, lithium, cobalt, and rare earth elements that the existing mining industry cannot meet. The average time from discovery to production is 15 to 18 years globally. The pipeline of new projects is thin because exploration spending was depressed for years after the last commodity supercycle ended. The mines that will supply the materials for 2035's electric vehicles and data centers need to be discovered and permitted now. Most of them haven't been found yet. That's the supply side. On the demand side, capital is beginning to rotate. Gold hit new all-time highs recently, and gold exploration always benefits when the yellow metal is running because it loosens the financing environment for the entire sector. Capital available for junior exploration is a leading indicator of the next round of discoveries. When money is flowing into the sector, drill programs get funded, assays get run, and the probability of discoveries increases. At the same time, the venture capital ecosystem is facing its own reckoning. The IPO window that LPs were counting on to generate distributions has been largely closed for several years. DPI, actual cash return to investors, is at historic lows relative to assets under management. Institutional LPs are frustrated, and many are quietly reassessing their private markets allocation. Some of that capital will look for alternatives. High transparency, high optionality, power law investment structures that don't require a 10-year lockup. That's junior mining. The moment when institutional capital discovers junior mining at scale has not arrived yet. When it does, the repricing event will be significant. Getting there first, doing the work, building the positions, understanding the geology, is the entire game. This is what early-stage VC looked like in 2009, when everyone was still shell-shocked from the financial crisis and the smartphones that would define the next decade of investing were just beginning to appear. The equivalent moment in junior mining is right now. Every episode, I try to leave you with something concrete, a frame you can carry into your next investment decision. Here's the one for today. When you evaluate a junior mining stock, stop asking the question a stock picker asks, is this cheap? And start asking the questions a venture capitalist asks. First, what is the discovery potential of this target, and does the geological model support a genuinely large outcome? VCs don't fund companies that can be good, they fund companies that can be massive. Apply the same filter to geology. Small targets with modest upside have no place in a power law portfolio. Second, what is the team's track record of creating and capturing value? Not just finding mineralization, anyone can drill a hole. Has management built companies before? Have they taken projects from exploration to resource to development to sale? Have they protected shareholders from excessive dilution? The people running the company are the fund managers. Evaluate them as such. Third, where are we on the Lassonde curve, and what does that tell me about the risk-reward? Early exploration is maximum uncertainty, maximum upside. Orphan period is proven geology, minimum sentiment, maximum value opportunity. Development rebound is lower risk, lower return, but still compelling. Know which game you're playing and price it accordingly. And fourth, the one I've added since episode 2, what is the macro environment for capital in this sector right now? The power law in junior mining only works if there are buyers for your winners when the time comes. In a sector with no institutional sponsorship and no retail attention, even a great discovery can sit undiscovered by the market. Track the money flows. Understand where sentiment is in the cycle. The geology is only half the equation. I started this episode with a number, 1,082% extended internal rate of return across 338 investments. I want to end with some context that I think makes that number mean something different than it might appear to. That return wasn't generated by being a genius. It was generated by understanding a structure, the same structure that the best venture capital funds in the world have used to build fortunes for decades, and applying it to a sector that the gatekeepers of finance have never bothered to properly explain to ordinary investors. The power law is real, the returns are real, the access is real, the transparency is actually better in junior mining than it is in the private markets. People are paying 2 and 20 to access. The question isn't whether this works. The question is whether you're willing to do the work, to read the technical reports, to understand the geology, to hold through the orphan periods when the market goes quiet and your thesis feels lonely, to resist the promotions and the hype and the newsletter stocks dressed up as world-class discoveries. If you're willing to do that work, and I believe you are because you're here, then junior mining is not a niche speculative corner of the market. It's a sophisticated, high-transparency, publicly accessible version of the greatest wealth creation framework ever devised. And you don't need Andreessen Horowitz to let you in. For the data that helps you do this work, drill results, assay updates, the companies making real moves, head to juniormining.gold. That's your edge. Mine data. Find your edge. Achieve alpha. This is Dusty Nugget. Remember, mining fortunes aren't built by guessing next week's candle. They're built by recognizing when the rules of the market are changing and owning the assets that reprice when the old system can't fake it anymore. Stay bold, stay scrappy, and I'll see you at the next drill site. You can learn more at juniormining.gold. Please like, subscribe, and visit our socials or our Substack for more content.